Good morning and welcome to the Leadership and Insurance podcast. I'm your host, Alex Bond, and I'm very lucky today to be joined by James from Eos Ventures. James, good morning. How are you doing?
Yeah, Alex. Yeah, how are you doing?
Yeah, I'm all right. I have to talk about the weather. It's the rule in my podcast as well, and it's a bit grim. So I'm not as good as I was the last couple of weeks. It's been a bit sunny. But where are you joining me from? What sunny, balmy side of the world are you joining me from today?
So just outside London, actually. My wife and I moved out sort of back end of last year. So sort of joined quite a lot of people, I think, who've moved out of the city and try and get a bit more space and been working from home now for almost a year. So
Yeah.
Crazy.
I know. I think we spoke before I joined the Exodus and moved to Brighton. So I don't know who's left in London nowadays, but we'll find out soon enough. But look, thanks for being a guest. I was talking about Eos Ventures to someone the other day, and you guys form a unique position in the sort of VC community. So I wondered if you might be kind enough to introduce Eos Ventures and what you guys do.
Yeah, sure. So Eos is one of the first global dedicated Insurtech funds. So we saw an opportunity back in 2016 to launch a venture fund and essentially bridge the gap between the new emerging Insurtech innovators and the insurance incumbents. Mm-hmm. And so we did that via a venture capital vehicle, and we really focused on the sort of strategic side of the business. So I say we're strategic for a number of different reasons. I guess the first is that we only focus on Insurtech or technology that has an application into the insurance industry. Secondly, the Eos investment team, and we're split between the US and the UK, all have complementary backgrounds, whether it's advisory, investment banking, venture capital investing, and as operators. But the glue that holds us all together is our insurance knowledge, network, and experience globally. And so then the third reason I say we're strategic is that all of the investors into our fund, they're all from the insurance industry. So we're working with insurers and reinsurers in the UK, Europe, America, Canada, and Asia. So they've invested in us, I guess, first and foremost for a financial return like any other VC. But we also have a very strong strategic working relationship with them. So we can act as their eyes and ears into the Insurtech world. We're complementary to any of their other ongoing investment in innovative projects that they may already have going. And we essentially act as an extension of their management team. So we can help them think through their innovation priorities. We can introduce them to our deal flow. We can introduce them to our portfolio. And then equally, all of our portfolio companies, have at least one commercial relationship with one of our investors or our broader network. So we really are trying to bridge that gap between sort of the incumbents and working in partnership with the industry, as well as investing in some of the sort of new emerging technologies that are driving value for the industry.
Brilliant. Thank you. There's a man who's done a few pitches on that.
Yeah. Probably sounds quite robotic.
No, it's good, succinct, but like full. I like it. One thing that I wanted to kind of dig into a little bit is how does that relationship work with the kind of investors of the fund? So you're working with big insurance companies, for example, that have invested in the fund. Do some of them have their own internal innovation venture function? Do you work in partnership with that? How does that sort of relationship work?
Yeah, absolutely. A number of our LPs do have, labs and various initiatives and chief innovation officers and chief digital officers. So they definitely all have their own internal processes and initiatives. I'd say that how we engage with each of those is different from investor to investor, and it's really down to how they want to engage with us. For some of them, it's just the regular monthly updates that they want to receive. And then sort of more ad hoc conversations and meetings on certain topics. It could be telematics, for example. What's going on globally in the telematics market, who's doing what, what technologies are out there. If we were to launch a product, what would it look like? So we do some ad hoc things like that. Mm-hmm. And then with some of them, we have more formal relationships around, forming sort of innovation working groups, where we're a little bit more embedded into their existing projects and almost act as a sounding board as they work through sort of different initiatives internally. That's great for us to build strong relationships with our investors. It's good for us to feedback what we're seeing in the Insurtech market. And equally, when we're speaking to new startups and new portfolio companies, having a good understanding of what's going on within our investor base, we can then make those introductions that benefit both the portfolio and the investors from a strategic perspective. But it's important to add that we're fully independent, so we have full discretion over where we invest, how we invest, which is obviously very different to a corporate venture arm or a CVC.
Yeah.
So we like to think that we have the independence and free of conflicts from a VC investing perspective, but we have the added benefit and value of having that strategic relationship as and when we may call on it, as part of building these portfolio companies.
It must be a massive USP to companies that, if you're pitching up against other funds or other investment vehicles, to have that in your locker, that that's where the money comes from, and you've got that kind of integration into those businesses. Is that the sort of key thing that people kind of focus on when they?
Yeah, I think initially they appreciate that we understand the industry. We understand the nuances of the insurance value chain and the products and the lines of business and customer demands and behaviors. So they're not having to explain the proposition or the market opportunity in quite such detail as they may have to do for a more generalist or generic fund. So I think they appreciate that in those early conversations, and then equally, all of the startups, they want to work with investors that can help them in some way over and above just money. And certainly the way that we like to work with our portfolio companies is helping them navigate the insurance industry, whether it's thinking about the product roadmap and what business model to pursue, all the way through to who are some of the strategic partners that you could go and speak to help you launch new products in new markets. Or a lot of the time Insurtechs are looking for capacity to launch their own MGAs. We can help facilitate those introductions into our investors and to our wider network to help them to find that capacity. So I think, and then as well with the Insurtechs that are focused on B2B software sales, it's hard selling into these insurers. And so if we can help with, even just one or two introductions into our network, I think that really helps the business. And I think the startups see the value in that. And personally, what we'd really like to do actually is co-invest with other VCs. So, and from a startup's perspective, they then get the best of both worlds. So if we co-led a round with a deep tech investor or a fintech investor that has got great experience of B2B SaaS sales, we can bring the insurance knowledge and experience, and they can bring some of the SaaS experience, and that seems to be a great combination that's worked well with a few of our portfolio companies already.
Yeah. So one thing, is that how you define smart money? But because the term smart money has been thrown around a lot, it's been a bit of a buzz phrase on this podcast. But what does that mean to you? Is it that kind of insurance knowledge, specialist knowledge of the area that you're investing in?
Yeah, I guess my view of smart money is really an investor that brings more than just money. So it could be an angel investor that spent 20 years in the industry, or has been a founder and CEO themselves, who is going to help you think through how to build the business, how to think about product development. And if they are someone who's well connected in the insurance industry, then they can help you with some sales opportunities. So particularly in the UK, where you've got the benefits of EIS and SEIS relief at those sort of early angel rounds, we're seeing a lot of startups taking some money from great smart angels that are going to really help them sculpt the business and get the business in good shape at that early stage, as well as warm introductions into the industry. And then for us as a VC, then yeah, we would also like to think, because we focus only on Insurtech and we know the market, that we can then help, you know, these Insurtech startups navigate the industry and unlock doors, whether it's new markets or new partners. And then, you know, that's what we set out to do 4 years ago, and that's what we've actually demonstrated in how we've worked with our portfolio companies so far.
And so, like in Insurtech, one of the challenges I foresee is that, you know, how do we define what that is? Because the scope is, you know, presumably as wide as all the way to kind of a full stack digital insurer. That's within scope through to, you know, some B2B technical solution solving like one small part of the value chain or one challenge. Do you look at it that broadly, or how do you guys define it?
Yeah, so I mean, you've obviously got different ways to look at it. You've got the business model perspective, which is what I guess you've just described around, you know, B2B SaaS all the way through to fully licensed carriers. And from our perspective, you know, we've invested in all different business models. We've done B2B SaaS, we've done MGAs. One of our portfolio companies is now a full stack insurer, as they acquired state licenses in the US to become a fully licensed carrier. So we're open to investing in all those business models. And yes, it's an important part of our diligence when we're looking at those startups, because you'll assess them on sort of different metrics and look at them from a different perspective. When I think about Insurtech, you know, the very, very broadest of definition, I'd say, is sort of any technology that's driving value for the insurance industry. And so occasionally we find ourselves looking at things like health tech. You know, we're looking at a business at the moment that's focused on open banking. So whilst they wouldn't be a pure Insurtech play in sort of that sense of the term, there is an open banking opportunity, you know, that is going to be able to create new services and products that are relevant to insurance customers and insurance companies. And so, you know, we look at those types of things as well.
Interesting. Yeah. And it's funny, actually, just reflecting on my kind of experience, that's been my understanding of it. I mean, I've most recently had a couple of health tech businesses reach out and say, look, we see there's a basically a revenue generation stream within their marketplace, which was from the insurance industry. So kind of looking for that insurance individual to come and bring that knowledge to the business. So yeah, starting to see that play out. I probably haven't proactively chased it down very much, but yeah, it particularly in the health tech space, I think that seems to be quite of interest. And then a lot of the IoT stuff, you know, the application is quite clear.
Yeah, I'd say there's a lot of adjacent businesses that are either sat on a wealth of data that's relevant to insurance companies but not currently being used by insurers. But there's also then you know, a whole host of businesses that have got a very loyal customer base, and they see an opportunity to sell insurance to their customers alongside their other products and services. So, you know, you're already seeing that. Everyone's talking about it sort of in the last year or so, embedded insurance. So you see those types of opportunities arise where you're starting to deal with companies on the peripheral of what the sort of the Insurtech definition is.
Yeah, it's interesting. It's sort of broadening the scope, particularly around the embedded model. I'm really pleased you came on. One of the things that comes up a lot in the interviews is you know, funding, challenges of funding, the scale of it. But I think unless you've actually done that process as a you know, a founder, and even someone that's kind of is a founder, they might not have gone through this process. Want to understand a little bit more about it. So I know that you said these kind of one of the sort of the same things, but what are the kind of most common things that people misconceive about the role of the VC, and maybe I'll roll it in as well. So what do people not know about the VC role? Like,
so there's probably a couple of things to mention. A decent chunk of an investor's time is spent on networking and deal sourcing. So, you know, across the Eos investment team, we probably on average speak to 5 new companies a week.
Mm-hmm.
And we've been doing that for the last 4 years. So that's a lot of companies that we've spoken to, we've spent time on, we've been pitched to.
Mm-hmm.
And then, to date, we've made 7 Insurtech investments.
Wow.
So if you think about that funnel, we've spoken to a huge amount of Insurtechs globally, and we've only made 7 investments. And that's pretty common across the whole VC market. And so if you sort of work that, flip that round and look at it from a startup's perspective, you are going to have to go out and speak to, 50 plus investors to try and find that 1 or 2 investor that's going to participate in the round. And maybe that's, it's clear to a lot of startups I speak to, but not all. And so actually, it is tough to fundraise. I appreciate that from a CEO's perspective. It is time consuming, but I don't think there's any way around it other than going out and speaking to as many investors as you can, and then running a very sort of tight process around that to try and be as efficient as possible. I know that there was a Harvard Business Review that was published, I think, a week or 2 ago, and they surveyed 900 VC investors in the US, and pretty much, unanimously everyone agreed that the best deals often come from their trusted, co-investors and, previous entrepreneurs they've backed and people that they work with and that network with within the industry. And so I guess you class those as warm leads.
Mm-hmm.
And I'd say, I think it was about 60% of the investments they ended up doing came from their network. And then another 30% was proactively the VC reaching out to the startup because they were researching a particular thesis or theme. I think only roughly 10% of deals were done through cold calls. So it's just worth bearing in mind the amount of startups that these VCs are meeting and how it's sometimes quite hard to get funded. And so if you can try and get those warm introductions, and obviously if you can have a very well-run pitch, all of those things help to try and to get you funded, basically.
Yeah. I was just thinking about that as we were going, because it seems to be the same. It doesn't matter what industry you work in or what kind of process. The best way to get a job is to get a warm referral from someone you know. Do you think the correlation is because the person making the referral is kind of all doing a bit of the vetting for you, or is it as the VC firm you feel more comfortable because you've had a referral?
Yeah, I think it's the former. I think it's more the fact that it's a vetted, it's a vetted introduction from someone that you respect and know, who has, a good perspective on the market, and you value their opinion. And so if they're telling you that they've been working with a company and that you should take a look, then, you might, take that obviously quite seriously. And then you've got a few other people there that you can do reference calls with and validate the business model. So it's really sort of that vetting process and that filtering process that you get from that network, I'd say.
It sounds more collaborative as a kind of community or that as an industry than perhaps outwardly you might think it would be, because imagine it's obviously competitive as well, but is there sort of probably more collaboration than we expect?
I mean, it is competitive for sure. And, just in the last couple of weeks, we've been involved in a process where a company received 4 term sheets. So there are definitely those competitive deals that you have to then position yourselves to try and be the investor that ends up being selected to work with the startup. But I find generally other venture capital investors are willing to sort of share ideas, regularly catch up, look at things together. And that's mainly because, there are only a very few dedicated Insurtech funds, and, we have relationships with most of them. So we have a good working relationship with them. But just more broadly, sort of the larger VC community who are more generalists and more tech focused, even more reason to have a working relationship with them because we're complementary. And equally, it can be quite rare for one VC to take the full round. So if a company's raising 10 million, typically what I see is it's a syndicate of investors rather than a one investor. And so again, that lends itself to, bringing in VCs that you've worked with before, that could help, and the lead investor sort of taking charge of bringing that syndicate together for the benefit of the company, really, because the company then gets 2 or 3 investors around the table who all complementary skill sets and backgrounds. It's going to help the business grow.
Sounds like the Lloyd's market, subscription market. It's a similar structure.
But also on the fundraising piece, VC funds have to go through that as well. When we raised our first fund, we had to speak to a huge amount of investors just to get the fund launched. So, we know the pain in the process from our own perspectives, as well as from the startups' perspectives.
What's within your sort of appetite? What's the Eos sweet spot? What does that look like in terms of kind of what stage you want to come in? What size of investment do you like to make? As transparent as you can be. I don't know what you can.
Yeah. Well, our sweet spot is Series A. And so that's sort of really a check for sort of $2 to $5 million. We can write larger checks, and we have done. We can write smaller checks, and we have done. And so we can sort of go one round higher or lower than that sweet spot. But really what we're looking for is a business that has got a strong team in place, has demonstrated some product market fit and some traction. And we feel like they're at an inflection point that if we came in as investors, we could be additive to what the business is already doing and help scale that business, faster. So, for example, if they've got, 5 to 10 customers already, that is a point at which we could invest to then help take the business to the next 20, 30 customers. The earlier companies that are still doing sort of the first 1 or 2 pilots, or still trying to, really find that product market fit, we have gone early at that stage, but I wouldn't say it's really our sweet spot. And I think that, particularly in the UK as well, that the seed funds and the angel investors sort of really do those early rounds, and then we can then come in and do a sort of larger Series A.
That's often talked about as the kind of difference between the US VC market and then your sort of European sensibility is that sort of Europe wants to see there's more traction already, whereas kind of the community is more kind of gets in a bit earlier in the US. Do you think that's a kind of fair generalization, or is that, or maybe that's reflective of EIS and things like that in the UK market?
No, I think it's fair. I think that a big, I'd say like a Series A in the US, you can end up getting sort of quite large numbers, and still have very little traction. Whereas I think in Europe, you need to see that traction really for that Series A. So I would agree with that. And then, other people, different investors have got different definitions of Series A and what they want to see. And I get asked quite often, what's the right number to come back to you and have a conversation with you around my Series A? Is it 1 million ARR? And what I sort of tend to say to startups is that a VC might tell you it's 1 million of ARR, but when you go back to them with 1 million of ARR, they might say, oh, it's 2. For us, we don't really have like a set revenue number to hit before we will invest. What we're really looking for is a business that's been able to demonstrate that they've moved away from the pilot phase and into sort of straight full production and full contracts, and being able to show development from those early pilots into full production multi-year contracts if it's a SaaS business. And basically being able to demonstrate that you've taken the business forward and you've got a repeatable sales model and a product that is driving value for the customers. The challenge that I always find is that a lot of insurtechs find it easy-ish to find the first 5 early adopters, and they can be quite big names, like quite big logos within the industry. And they will be working on particular specific pilots, which is great. What's really, really challenging is taking those first 5 early adopters and then growing it to a customer base of 15. And so, and actually a lot of businesses have come unstuck in the past, where they've gone out and raised a lot of money at quite a high valuation off the back of these sort of first 5 early adopters because they're great logos. But the business and the startup has then struggled to continue that momentum of traction and hasn't been able to grow into the valuation that they raised at. And so then they end up having down rounds or struggling to raise money. So you can sort of fall into that trap as well when you've got those early adopters and then struggle to then push on and sell to more customers. And so when we come in at Series A, what we're really saying is that we want to see a company who's been able to demonstrate that they're at that inflection point where they've been able to move away from those early adopters and they've got a product that works, that's driving value for the industry, and can be, we see a line of sight to the next 15, 20 customers.
I mean, we've covered a large chunk of kind of what I was going to ask you there. So I suppose getting more granular about it, that's kind of like where they are as a stage as a company. But I get asked this a lot because I think I've got my phrase that I like to use, that I think every insurance professional I speak to thinks they've got one good Insurtech in them, like everyone's got one good book. But we get to this pitch point and everyone's like, I don't know what to put in a pitch. So what, I suppose we could mash them together at your suggestion, because you said, like I said, what makes a good pitch, and you were like, oh, it's kind of what makes a bad one is just as important. So it'd be good to kind of get into a bit more detail, because I think you've covered off where they need to be company wise, but what makes a good pitch? What are you looking for? If someone gets their 5, 10, 20 minutes, I don't know what they get with you these days, but what makes a good one?
I mean, you've got to hit all of the key points around team, product, market, those, the usual stuff that most people will say goes in a pitch. I guess to be more specific, we really spend a lot of time thinking about the team. And what is the manager, and not just the CEO as well, the whole management team, because in the early stages there tends to be maybe one CEO that does wears 5 different hats, and over time you have to hire great talent, as to take the burden away from the CEO and keep the business moving forward. So we really like to understand what the team composition looks like, and on the pitch it's great to have some of those senior members of the team on pitching their particular and relevant parts of the business. I think it's quite easy with a pitch to get bogged down in the detail and really focus on the product and the market opportunity, but we really like to think and spend a bit of time talking to the team, understanding their experience, whether it's more weighted towards insurance, whether it's more weighted towards tech. Are they a first-time CEO? Have they done this before? Is the team complementary? Is it a team that we think that we could work with over the long relationship we'll have as part of an investment? So it's really an opportunity for the startup to show sort of the strength and depth in the team. And what we're asking ourselves from an investor perspective on the other side of the fence is, the answer to the question really is, why is this the right team, and will they be able to execute on the plan and be successful? And I guess to flip that round, what do people do wrong in a pitch is sometimes the CEO will let others pitch, and that's great to hear other people in the team, but it's really important for us to understand the CEO's vision, their aspirations, the way they think about culture, the way they think about business building. As they're ultimately responsible for the success of the company. So we don't really like it too much when the CEO shies away from presenting their own business, but absolutely love it when it's sort of shared around the management team. The other thing I'd say is sort of just preparation. Some of the best pitches we see you know, they've got the right people on the call. Everyone knows the key points to cover. They've rehearsed it. They use slides to where they need to make a point, but don't overuse slides. You know, so a lot of them have prepared FAQ documents that can be sent after the pitch, because a lot of investors have similar questions. So I really think being completely prepared, knowing who's saying what, hitting all of the key points, you know, you think that was obvious, but actually it's quite refreshing when you see a startup that just nails it, covers everything, well prepared, you know, hand off between them very, very swiftly and cover all the key points. And, you know, that's an engaging pitch, you know, that's a memorable pitch. And given, like I said at the start, we speak to 5 to 10 companies a week, you know, that's sort of really what you want to be leaving the investor with, is that memory of the strong pitch. So I think that's an important part in the team.
I think that's really interesting, because you know, I think your phrase just then like nailed it, because I think we say things obvious. So it'd be the same as me. I think when I'm telling people about the interview process, I sometimes you know, you sit on the balance of going, am I stating the obvious to people that are quite senior? But the reality is, you know, it's not always obvious, and it doesn't, even if it is, doesn't mean people are prepared for it, because they're nervous and it means a lot to them and there's a lot of stake. So I think there's a value in pointing that out and being rehearsed. But I'm surprised how much of the focus is on people. You know, like most of what you said really was like having the right team, having the right people. So is that the priority over, you know, could you have a great product or service that's just got the wrong people, and therefore for you that it's never going to work? Have you seen that?
Yeah, for sure. I think certainly the earlier you invest, you know, team is fundamental to the success of the business. You know, they have to be able to execute on the plan. They have to be the face of the company, going speaking to customers, you know, keeping the team happy, you know, making sure you know, you're working with the right partners, keeping all areas of the business moving forward. You know, a lot of the time we see businesses that have got a great product, you know, it makes a lot of sense on paper, but maybe they just don't have the team in place to be able to execute. Equally, if you invest in a very, very strong management team, you know, they might have to pivot 3 times. They might have to change the product. They might have some setbacks. And that's pretty much always going to happen when you're investing in startups. So if you have a strong team that is able to adapt to those changing dynamics, you know, you've got a far greater chance of them being successful and executing on a plan than a team that maybe isn't as strong. So yeah, I'd say team is a very important factor in our assessment of an investment at an early stage.
And so on the team front, is there a theme of skill sets, people, roles that the startups tend to lack, the ones that you think are kind of, whether you fund them or not, I suppose, you know, because is there a theme there?
You know, we typically like to see a blend, because we only focus on Insurtech. You know, we typically like to see a blend of insurance experience and, you know, entrepreneurial and tech experience. You know, people who know what it's like to work in a team of 10 and grow it to a team of 100. You know how to build scalable products and technology. But then also people who understand the insurance industry, you know, speak the language of their customers, understand how underwriters will be thinking about using their product. You know, think about how insurers are going to be thinking about partnering with them from a capacity perspective. So having that blend of insurance and tech experience, I think, is very important. You know, we will invest in first-time founders, you know, and we have done, where we've seen potential, we've seen, you know, a very, very strong team. But equally, if there's a company that's, you know, founder that's been there and been successful and had 2 exits before, then obviously that, you know, and they've demonstrated that they've been able to scale businesses in the past. They know what it takes to build these businesses. You know, it's very, very difficult for you know, corporate people who've worked in a corporate environment their whole lives to then go and work in a startup of 5 people. And the change is just, it's just chalk and cheese. And, some people flourish and some people really struggle. And that is, some of the considerations that we go through when we're looking at team.
Yeah, I see that a lot. There's a book of What Got You Here Won't Get You There. It's a book I've read, and I can't remember the author now, which is rude of me. But I always think that a lot when I'm talking about people, because I deal with execs all the time. They're in insurance exec going, I want to go into the Insurtech world, and I get the kind of want, because there's so much press and it looks exciting. But I always have to flip it back and go, well, what do you bring? And obviously there's insurance knowledge there, and it's valuable, and sometimes it is, but sometimes it's going, you need a broader skill set than you're possibly doing at the moment, because in more established businesses, your roles are much more siloed, so you become very specific on that area. But obviously, in a startup of any nature, you're doing. I was talking about someone who did his fundraise the other day, and the first thing he had to do was come back in the office and take the bins out, because there was no one else to do it. And I was like, that's the lifestyle. So look, I'm conscious of your time, and we sort of, I think we've covered some really good ground there. But what did the pandemic mean for you? I wanted to sort of know that. Did you manage to kind of operate through it? Has it changed the way that the fund's going to kind of work going forward, even just from a kind of physical standpoint? Did that have much of an impact on you guys?
Well, I'd say as a firm, we'd been fairly used to working remotely prior to the pandemic. We've got offices in the US and the UK. We've got advisory board members globally. And so we're fairly used to working remotely and on video. So it wasn't too much of a change for us personally within the business. There was a change. It was a slight shift in how we approach diligence, because prior to that, we like to sit down with the CEO, we like to sit down with the management team. We like to do a number of different sessions talking through different elements of the business. Even in a social setting, it's great to go out for dinner and have build that more informal relationship as well. So there was definitely a shift of how do we continue to have that type of rigor in our diligence process without actually meeting someone face to face. There was a bit of figuring out at the start of the pandemic, and we've done deals during the pandemic, and we've actually found that video actually allows you to maybe have more sessions than you previously did face to face.
Yeah,
you can speak to more people within the business, you can do more reference calls, and so we may have actually ended up having more conversations with the management teams than we did previously, albeit not being able to have that sort of face-to-face interaction and maybe that more informal interaction that we've obviously had to change our approach to.
I read something on the Harvard Business Review yesterday, actually, and it was a report about communication, effective communication. And if you see, your VC, whether they're pitching or on board as part of the same team, they were saying effective communication face to face was basically as effective on Zoom or any video call, as long as it was kind of closer to one-to-one than one-to-many. It was just as good as face-to-face, which I thought was really interesting, because one thing that I've learned is that we're getting better. I think the skills, everyone's getting better skills at kind of doing the kind of video call. But that's what I was interested in, to see if it kind of made you guys deal shy, but obviously not, because it just changes you, because it changed my process, it changed my interviewing process. So I imagine it would change yours.
Yeah, I would say also at the start there was a short pause, because we turned our attention more to our existing portfolio and how the pandemic had impacted them, whether there were changes that were needed in the organization, whether sort of the health and happiness and working situation of the teams, how what did their cash flow look like, and did they have sufficient cash if there was a significant drop in revenue. So we spent a lot of time with our portfolio making sure that they could adjust their businesses and helping them think that through. And we're pleased to say that they all were able to adjust and make changes and ride out the pandemic. Some of them even raising decent funding rounds, during the pandemic, which is, I guess, a testament to the team and to the business they've built. But once we'd sort of spent time doing that in the first couple of months, then we continued to act as normal, really, in terms of probably more conversations than ever, to be honest, from a deal sourcing perspective, as companies were maybe pulling their funding rounds sooner than they'd anticipated, because there was more uncertainty in the markets and the economy. So there's certainly been a lot of companies out raising money, a lot of conversations we've been having, even albeit remotely.
Yeah, it's interesting how these things have played in, but it's such an important part of the process is the diligence, and that face-to-face diligence is still seems to be prioritized. So that's interesting. But look, James, I won't overstay my welcome. Thank you very much for being a guest. I really appreciate it. Obviously, there'll be lots of super interested parties kind of looking for that VC funding. So I suppose rather than open the floodgates and tell everyone to email you directly with their slide decks, what is the best way to approach you guys? And what is the best way to kind of someone to reach out if they're looking for funding or at that stage?
So LinkedIn, Twitter, email, all good ways to get hold of us, through our website. Happy to speak to companies that sort of focus at the Series A stage, and I'm also conscious that when you ask me what makes a good pitch and a bad pitch, we didn't get further than the team. So there's obviously quite a lot of other things that we feel go into a good pitch and things like that. So always happy to have further conversations with people on that topic, and even yourself. But we didn't quite get past team.
We'll have to do a second series. That's for sure. But but now I feel like I can't leave it now. I'm like, what? I'm now like, what extra? But yeah, I tell you what, we'll come back to it. I'll do a white paper on what makes a good pitch. That's what we'll have to do next. But
what I would say is just on the pitch. A really important part for me is the go-to-market strategy. I think there's definitely a view amongst some startups who are heads down on their idea because it's a great idea. But I think it's easy for some startups to think, if we build the product, the customers will come. And you think you can ask any B2B SaaS business, trying to sell into the insurance industry, and they'll tell you how hard it is, how you need to find the right sponsor. Then you need to navigate the large organizations, then your sponsor leaves, and then all of a sudden the sales cycle is 18 months. So having a really clear idea on that go-to-market strategy, even if you've got the best products in the world, how do you get it in the market? How do you scale and grow? They are really important questions to answer. And the businesses that have got maybe different channels to market, whether it be direct, whether it be through channel partners, whether it be through affinity partners, who really know what it takes to scale the business. They're the pitches that are refreshing and well thought through, and quite often are answered quite badly. And it goes back to my point, is that you can find those first 5 early adopters, but how do you really scale? How do you go to market? How do you get to the next 15 customers? That is what I think startups should really try and nail and think through, and have a clear view in their mind as to how they get the business scaling.
I mean, that makes sense, because I think reflecting on my work, like most of my assignments in the Insurtech space are in chief revenue officers or head of sales, or whatever they want to term it. But it's building that strategy of how do you sell and get that product out there. I think usually, because the founders are based, it's building something around a tech, or so it's generally kind of focused the people that deliver that tech solution. Everyone expects to be Atlassian, and they don't have to have a sales team, and it's going to go out there. But because sales business development tends to be the sort of dirty word. It's like the bit that people don't want to do. But I don't know. I think there's culturally something against kind of that part of the process, but you need people to kind of sell it. You need that marketing and sales piece.
Absolutely. And what I always find helps in that process is that if you've built a product that is driving value for the industry, and you are driving value for your early adopters, that is really the sales pitch, and I guess the general rule of thumb is sort of how we think about it, how others think about it in the market, is that, if you want someone to pay $1 million a year in licensing fees for your platform, they really have to see, up to a 10x in value. And so what I think startups need to be doing at those early pilot phases is actually demonstrating the tangible value that their product delivers to the end consumer or to the insurance company, and then that gets threaded into the sales message and pitch to the other customers, in that this is the value that we expect to drive from our platform. All of that helps with the sales process, and I think that I don't see enough startups really being able to articulate and demonstrate that value and threading that into their sales process.
It writes itself, right? You're writing your own.
Yeah, I think that's when you turn a meeting you have with an insurer from like that was a really interesting conversation. That's a nice to have Insurtech platform. You turn it from a nice to have to a must have. You need to have the customer walking out the room being like, we need to work with these guys because they're going to transform XYZ. They're going to deliver this much value. It's going to move the needle for us. It's going to create competitive advantage versus our competitors. The startups need to be getting in those rooms and having those conversations around sales and turning interest into cash, basically.
and that's the sales guys. That's what they're there for. I had one that everyone was all the tech people were in one building, and all the ops and everything. And then they put sales on a separate floor because they were like, "Oh, we just don't want to be near those salespeople." And so it's definitely a sort of a culture clash there. I mean, that's the kind of old-fashioned view of sales, and I think sometimes it gets, it's almost seen as kind of ugly, but it is exactly as you say.
Yeah. What you were saying about hiring people, we're talking now about sort of B2B SaaS Insurtechs, but sure. What you were saying about hiring people, particularly challenging, is that sales role, because you need someone who understands the product, who understands software sales, but speaks the language of the insurance companies, and knows the buyers, whether it's the chief risk officer or whether it's the chief underwriting officer, or whether it's a particular underwriting unit. You need someone that can talk the language of the insurance companies, but have that expertise around software sales and building a solid software sales function and RevOps function.
It's certainly not been easy. I mean, that's one thing I would reflect on. Finding good, chief revenue officers or sales guys or business development guys, whatever you want to term them, is incredibly hard, because it's that juxtaposition between knowing the market, knowing SaaS, and knowing insurance is really hard to find. I won't say it too much, because that will just increase the prices of the people coming in and make my job harder. But look, James, I'm glad we got that in. I'm sorry I sort of jumped over that bit, but yeah, because it was really valuable to have you on. So thank you very much for being a guest. I really appreciate your time.
Yeah, thanks for having me, Alex, and good to chat.
Thanks a lot. Bye.
Yeah, bye.